Hi everyone, we're back. We're back to talk about pressing matters, big questions that incubators across the country and perhaps in many other nations across the world also face. Over the last couple of episodes, we've dealt with several of these topics. I am hoping many of you have joined us for our previous conversations. Today, we are actually going to talk about something that lies at the juxtaposition of where an incubator operates, a space in which an incubator operates, and where the other VC funds, would operate. And obviously, we're going to talk about investments in startups, but limit ourselves to what does it mean? How does it pan out? What are the good practices for incubators when we talk about investments in startups? I have Chintan with me. He has massive amount of experience. Looks at least a couple of startups almost on a daily basis. From particularly from an investment point of view, and then there are other things that are on his plate. Welcome, Chintan.
Thanks, Supriya. Hi, everyone.
Great. So, Chintan, I was to prepare for this conversation. I was quickly doing some search to gather as to where does the investment activity anchor at the moment, and I found out that there are in 2022 until let's say mid October, about 42.2 billion US dollars had flown as funding in Indian startups. Now, out of this, there is roughly about 1.4 billion that that took the form of seed stage funding, and this was raised by about 1,300 odd startups in the country. Now, if you were to look at these numbers, since these are estimates coming from just one source, I should have done my search more comprehensively. But my sense is that these numbers would typically reflect the seed funding raised by startups from mainstream investors. Incubators, like we know them, operate actually in the space before a startup would raise seed stage investment from various sources. And therefore, one of course one can estimate as to how much money flows into investments made by incubators into startups, but what are the good practices? How do you do that in a way that makes sense for the incubator and the startup both? These are a couple of questions that I had listed down. I wanted to raise them with you. I will begin with asking you as to about what forms could this investment take.
Yeah, no, I think as you mentioned, Supriya, that this data probably reflects seed investments which would have happened uh, at the more mainstream investment level. So there's going to be a bigger funnel which is operating before this stage, and that's really the stage where the incubators come in. In conventional investment terms, we call it the valley of death,
Yeah.
which is where startups kind of are unable to emerge out of it and reach the seed stage where more conventional funds come in. So I think that space before the seed stage, where incubators can play a role as a very early stage investor, is much more complex. And as you mentioned, the question that you asked is what are the kind of flavors of investments there. So I think I would say there are broadly 3 or 4 types of funds that investors can bring in. There are, of course, to start with, very early stage grant funds, and a lot of these typically would come through government, whether it's the various departments. Even at the state government level, there are some funds which can be leveraged there by incubators, and those are for very early stage validation. And because these are grants, it assumes that a startup is at a stage where they may not have a clear understanding of the customer, their market, business model, etc. And it's really to validate the product and the value proposition. So that's one stage, and those are typically bets that an incubator would take simply on the basis of the team, the seriousness, and what they are trying to solve, and their technical capability. At the next level, there would be, I would say, funds which are more in the nature of either convertible notes or convertible debt, right? Now, these would be again funds which could come typically from the government, or in some cases also from CSR funds, etc. And these are more for slightly more mature stage of startups. And the distinction that I was trying to make there between convertible debt and convertible note, and because both of them would be at a stage where it's very difficult to do a valuation of a startup. I mean, the
Mm.
startup would still not have a steady stream of customers and revenue. They may have some MVPs or initial validation done, but it's slightly better than the first stage. But it's still not at a stage where a proper valuation or a price round can be done. And that's where you look at a convertible. Now, the distinction that I was making between debt and equity again comes in specifically for incubators which are located in tier 2, tier 3 cities,
Yeah.
because as we have seen in various regions, a lot of enterprises in these regions may not be enterprises that, based on their business model, technology, etc., may not scale up to a level where they can go for conventional VC funding. But they are operating in markets which are, or they have a business model which are inherently profitable, and they are operating in markets where the startup can achieve a high degree of growth towards sustainability, financial sustainability. So that's where it probably makes sense to do a convertible debt. And in cases where I think we see potential for a further round of funding, the market is large, a higher growth, there I think a startup can go for a convertible note. So that's the second stage, and then the third stage is really equity funding. My sense is that most incubators are operating largely in the first and the second stage. Third stage typically is also there, but I would say that funds in the third stage would tend to come more from the more, I would not say private, but at least the CSR funds, or in some cases, they may come through programs which are designed to help startups raise the initial pre-seed funding, maybe through multilaterals, etc. And there it's more of looking at pure equity funding in startups, which are, and that's more like a almost like a bridge round where you are sort of investing so that the startup can then start approaching the more conventional venture capital, commercial capital. So I think these are the three stages and the different donors or partners that you can partner with as an incubator to get the funds.
That's wonderful. Chintan helps put it in order as to grants, convertible notes, convertible debt, and equity. I do want to double click on this distinction between incubators and a mainstream VC fund. Are there differences in how, let's say, an incubator would function, would invest, would follow up?
Yeah, no, I think it's again a very relevant question because, as you rightly said, I mean the investment activities conventionally or in a mainstream sense was always done by VCs. I mean, incubators playing that role of very early stage funding providers is a new phenomenon, and a lot of us incubators have actually learned the tricks of the trade as we went along. But we started with a framework that would typically be used by maybe angel networks or venture capital and all that. The distinction, of course, is that incubators would be dealing with startups which are at a very early stage. I mean, a lot of the metrics that a typical VC would use to evaluate and incubate to evaluate a startup may not be available. So, for example, a lot of these startups will not have traction, customer acquisition, retention, things like that. So, you may not be able to use that as a way to evaluate a startup in terms of whether to invest or not. So, therefore, you would need to place an inordinately higher amount of focus on the team, maybe on the extent of the problem that the startup is trying to solve, and their approach. I mean, how unique is the approach, how well they have thought through it. So some of these slightly softer non-quantitative factors rather than the more quantitative factors that a typical VC would use. So I think that's one part of it. I think the second distinction, I mean, there are many, but I'm just focusing on some which are prominent. Second distinction is that again, it's similar to the first one, that after you have invested, typically what a VC would do portfolio management and tracking and use financial metrics, and a lot of these metrics would be tracking the growth on a month to month basis, whether it's growth in customers, whether it's growth in your gross profit, customer retention, these kind of metrics. Again, because incubators invest at a very early stage, it will probably be 3 to 6 months before some of these metrics become important. So they'll have to actually develop their own metrics, which are more in terms of validating the business model.
Yeah.
How close is the startup to attaining unit economics positive? Is their customer acquisition cost kind of coming down, and sort of helping them achieve a better unit economics? So these kind of metrics would be more relevant. I mean, a lot of these metrics may be more in terms of validation and less quantitative. So the metrics that the startup or the incubator needs to be tracking need to be slightly different. And related to that, even during the portfolio management process, once an incubator has invested in a startup, the startup would still require a lot of hand holding, mentoring, a lot of support, structured as well as unstructured one-on-one support, uh, not just simple tracking of metrics and network access, which a typical VC would do, but more deeper initial level fundamental support. So I think these are the two distinctions between an incubator functioning as an investor versus a more commercial VC operations. Yeah.
Makes sense, Chintan. I will, a little while ago, you were talking about, you told us a little more about evaluation. Are there any good practices on evaluating startups that incubators could follow, particularly with investments?
Yeah. So one of the things that see one of the other kind of disadvantages that a typical incubator may face once they start investment activities is that they may not have trained manpower in terms of having investment professionals as part of their team. So while they need to be able to be diligent in terms of evaluation, they also need to make sure that the team gets trained in the process. So one of the processes that we have followed at CICO is to have almost like a mirror image of a IC, what we call as an internal IC. So when a deal champion, or let's say an incubation manager gets a startup, so we have a framework on the basis of which you evaluate. But the startup goes first to the what we call as an IIC, or an internal investment committee meeting, which almost operates like a regular IC, but it doesn't have any professionals, as part of the investment committee meeting. It's just the internal team members who almost role play an IC. So it does two things. One is that it makes sure that there's a filter. There's a two-layer filter. First is what the manager or the team member does, and second is the IIC. And it also trains the team on how to do due diligence, how to evaluate, how to, what are the kind of questions that get asked in terms of when a startup is presented. So the learning also gets incorporated and kind of gets spread across the organization. And then once that filter is crossed, it goes to the IC. And typically, the IC will have a lot of the donors may specify that you need to have these kind of members in the IC. But even if that doesn't happen, the IC needs to have people with professional investment experience, maybe from the venture capital industry, or if it's a sectoral kind of a fund from that sector, successful entrepreneurs. So that becomes like the litmus test, the final test of, and one of the metrics that we track is that what's the conversion rate between our IIC, or the internal investment committee meeting, and the IC, and that needs to be improving over a period of time. Yeah, so this is one aspect that I just quickly wanted to touch upon. Yeah.
Great. Helpful, Chintan. We did speak about a lot of things. We spoke about different forms that investments could take. We spoke about that distinction between a VC versus an incubator with respect to investments. And then, of course, we spoke about some internal process, good practices with respect to investments. What really, and I made a side note of it, what really struck me is the absence of markers. That would be typically those that will be typically available to a later stage VC, with respect to the business performance, those are nearly all of them are absent for an incubator, and therefore you look for um, um, some signifiers of some proof of performance, either in the founder or in the idea or in the market readiness, or even how vibrant is the market. And yesterday we were talking about this the student entrepreneurship investments that we are doing, that we are supporting, and sort of these two just came together, that you look for a founder that has shown some proof of delivering something, even if it's not a startup, but they have that ability to close the entire circle.
Right.
Great. This is very, very helpful. Chintan, thanks so much. For those who have joined in, thank you for listening in. I am hoping that this, and if you're an incubator manager, I'm hoping that this will contribute to your mission to develop investment instruments, processes that make sense for you as an incubator and your startups. We also recently came up with a playbook for incubators. I suppose we will leave a link to the playbook somewhere here. Do Please feel free to access the playbook. If you have questions, you can find us, of course, on LinkedIn or on CICO website and other platforms. Um, that concludes our chat for today. This was wonderful. Thanks again, Chintan.
Thank you. Thanks, Supriya. Bye.